Hey everyone, Tim Melvin here, and welcome to today's edition of Hidden Profit Report. As you can see, I've got this really cool hat on, and it's got a mailbox logo on the front. There's a story to that. I'm going to take that off because I look ridiculous in hats. But the hat was sent by today's guest. That's Ryan Krueger of Freedom Day, which I'm going to negotiate for Ryan in case anything ever happens to him. I want the name. And I'm just super jealous I did not think of it first. Ryan, thank you so much for being on with us today. I absolutely love the artwork wall behind you there. Is that kids art or?
It is. It's my daughter's art, which thankfully to me looks just as good as the masterpieces of the world. And as a value-oriented investor, the price was right as well. So my decorator was never needed, which helped me a lot.
There you go. I've got some granddaughter art around here that is of the same quality and irreplaceable value. So, anyway, thank you so much for being on with us today. And I'm going to jump right in. Start with Freedom Day. What is it? Where did the name come from? What are you up to?
Well, I'm delighted to be here. I hate to disagree with the host so early in the interview process, but I thought you looked really good with that hat on. You're going to run into all sorts of good luck and karma. Our client, friend, and artist drew that for us, which actually means a lot to me because it took, and it still takes folks, even that have worked with me for 3 decades, a long time to really realize what I meant by Freedom Day. And I tell them, don't take my word for it. This is a mathematical formula. And it's supposed to feel good, and it will, but so he drew. His aha moment was when he drove around. It feels like everybody in my neighborhood had the red flag of the traditional mailbox pointing up with more invoices going out. Then one day, and he drew the green flag pointing down to feel like when more checks are arriving in the mail than invoices going out. And in his case, and in my case, those are dividend checks. But Freedom Day to me wasn't something I stumbled into and started on a whim, and I don't take credit for the idea. It was really learning inside the belly of the beast. I started out at the biggest brokerage bank firm in the world at the time, and I was surrounded by advisors and retirement plans, and it was always about an age and an asset level and all sorts of anxiety related to that. And we set up this dysfunctional relationship, I noted, over the several years of me listening and learning and note taking, expecting the market to do things for us to get us there to retirement or to keep us in retirement, when in reality, and the math behind this Freedom Day was at any age with any size asset nest egg, if the free cash flow was exceeding your needs and wants with a contingency bucket of cash, you could do something better than retire. And that's why we call it Freedom Day.
Okay. It's a great concept. And of course, you've got a ETF, and it's the symbol's MBOX for mailbox, but it's just straight up. It's originally named Freedom Day Dividend ETF. I mean, tons and tons of thought went into it, but that's exactly what it is. Tell us a little bit about the strategy that you're using, because I'm impressed by it. I love what you're doing. I think that this is an answer to a lot of problems out there that people have reaching for retirement. So tell us, just kind of generally about the strategy, and then let's get into some detail on it.
I'm happy to. So it is a new ETF, but it is not a new portfolio or process for me. I had run separately managed accounts with a dividend growth equity concept core backbone to the largest portion of our firm's assets. When I left the big firm, I started an RIA with zero assets in 2006. So from our previous firm through our entire history as an RIA, we've always run this dividend growth separately managed account strategy. And for anybody that's not familiar with that Wall Street term, that just means individual shareholders who own the individual same 50 companies that we own today inside the ETF. I wasn't looking to launch an ETF. The last thing And we don't have a sales or marketing department. We definitely don't have any distribution. So I'm probably should have been the last person, because you enter that world, um, and up against these behemoths. And as I joke, that makes David versus Goliath look like about an even draw. Um, but when some advisors politely tapped me on the shoulder, knowing that we had done this very well, and that the dividend growth portfolio it's a repeatable process. It's none of my ideas or predictions, all math, evidence based. They said, we would love, if you ever consider do this in ETF, other people would want to use it too. I still pushed back, and I'm a slow moving vehicle. And it took me about 2 years of due diligence and research. And among the reasons that we did this, I couldn't unlearn what I learned about the tax benefits alone.
Right.
I could have done the exact same strategy, which we're still doing, inside an ETF with extraordinary tax advantages for the shareholders.
Mm-hmm.
And if I knew I was going to be doing this for another 30 years and I don't know how to do anything else, and I love our work, it became a no-brainer. No matter how much it cost me, no matter how much time it took, no matter the hassle, no matter going back into the regulations and FINRA, and I joke it felt like Buckner walking back into Shea Stadium. I was free of all, but I took on all that pain for a very, very simple reason. Even if it was just for the people that already trusted me, mm-hmm. It was a significant upgrade in the math for their next several decades. And the fact that we could then share it and meet other people in the process, it became a no-brainer, and I had to do it. I felt obligated, frankly.
Okay. We moved the question from the back to the front of the discussion, but you touched on it, so let's get to it. Tax efficiency and exchange traded funds is something that's critically important, and nobody talks about. You hear zero discussion about this among most mainstream media financial outlets. Talk about the tax efficiency advantages, because they're massive, of an exchange traded fund over owning the stocks outright yourself, or through a mutual fund or even a hedge fund.
Having experience in all of those products and worlds, I was frankly surprised. And the answer to your question, and it's a deep dive in the weeds, nerd out with original IRS rulings, and Vanguard was actually at the front of the line. So even if you did have any worries politically of how long this would last, this is helping more people than any other rule I have ever come across in the world of investing. So I don't think this is going to reverse. But I'm a hardcore sell discipline guy as a portfolio manager. So my first biggest red flag was, to what do I owe this great act of generosity? It seemed too good to be true. And I usually run like hell when I trip across one of those red flags. And so it took me a long time. And I think the simple math of it all is that capital gains do not have to be distributed like they do in a separately managed account or a mutual fund. And a separately managed account, or some of this direct indexing, and you can manage taxes very effectively. I mean, our separate account program versus traditional mutual funds was unto itself already a huge tax break, because each investor, and any investor listening to this right now, if they don't want to sell some of their own shares, they don't owe any capital gains. What sadly too many people didn't realize, and still to this day don't, is you could own a mutual fund and the fund be down and you still get stuck with it.
You're going to get a tax bill. Yeah.
So that's why you're seeing some of these conversions from funds to ETFs. But the redeem and create inside plumbing that I trust our mutual friends at Alpha Architect to run for me, and they have an unbelievable SWAT team of PhDs and Marines, and I mean that in the literal sense, with even bigger hearts to make sure all of this works flawlessly, is you're not selling shares that are kicking out capital gains to the end shareholders in this case. So the only capital gain an investor would own is if they chose to sell their shares of the ETF itself.
Right.
So some of this tax efficiency, especially in the indexing, was somewhat widely known, and the efficiencies of an ETF and the lower cost was a huge boon to any individual investor. What was really not well understood, and as we're having this conversation today, so credit to you for sharing this part front and center, because I don't take credit for any of this. It's just a huge break is most folks still don't realize that this exemption applies to actively managed portfolios as well. So this was a gigantic eye opener, and still to this day, 9 out of 10 ish professional advisors that I talk to don't realize that I can run an actively managed portfolio and still get this tax exemption inside of an ETF. So I think we're very, very early days. Now, the only caveat to that, so when we launched it, Bloomberg interviewed me and said, why in the world wouldn't every advisor do what you've done? And we were only one of at the time, and we launched in 21. So maybe it's a little dated, but directionally it's not. There was 6 RIAs in the country that had launched their own actively managed ETF. And it seems like such a no-brainer because of all the math we're talking about: lower costs for investors, significantly lower taxes. The only problem, and the reason it won't be a one-way stampede, is that it is extraordinarily expensive for me. So most folks in my world, even the best among them, they don't like taking pay cuts and coming out of pocket.
Right.
A lot, but
because it is a pay cut, isn't it? If you're charging 1% as an asset manager, you're not getting that for running an ETF or anywhere close.
And all of the advisors downline in that firm. But if you view this as serving people and doing right by people, and that will be the reward eventually that will come back in many different ways, then to me, I will state again, it was a no-brainer for me, but it'll be difficult for many. But yeah, that tax break is a real big deal.
Yeah. Okay. All right. So tax break out of the way up front. Just, guys, massive advantage if you think about owning something for 20, 30 years. So let's say you're 40 years old looking at retirement. And this strategy that Ryan has developed is really, really good for that. And I've talked a lot about dividend growth over the years, and it is a powerful component. It's the centerpiece of yours. So walk us through kind of how this works, and tax advantages there, so we can do all this without worrying about capital gains taxes. But how are we selecting the stocks to go into this strategy that make it so powerful?
And this is the reason I'm here, and this is what I get most excited about, because for all those reasons and several others, the last thing anybody ever needed was another fund or ETF. Okay? I'm very humble and realize that we have plenty to choose from already. And I am a huge believer in deeply informed simplicity is really the holy grail for anybody listening to this, no matter how they're investing, whether they agree with my style or not. That's what we're really looking for. So I simply am a deep believer in dividend growth and felt obligated to launch this because the choices for growth are endless. The choices for income are endless. And the debates among advisors and investors are, do you need to allocate more to growth or income? I think for the next 30 years, and I was willing to bet my career on it, that the biggest unanswered question was, how do we achieve growth of income? And dividend growth of the highest quality is absolutely the answer to that question. It's not investing better to withdraw more or less, and all the anxiety that revolves around that. So dividend growth, it's a real simple metric. The quality and the selection process, we can go into any of that deep dive, pop the hood, nerd out session if you want. But dividend growth, the beautiful math of it, and the reason we call it mailbox money affectionately, is most investors or funds looking and talking about dividends, including, and I'll even play devil's advocate right off the jump here, other investors that I know and respect well, professionals, would say dividends are a very inefficient metric. It's not tax friendly for the investor. It typically is circling older stage companies that don't have anything better to do with the cash. And there's a lot of people that make a tax on dividends and yield, and that's not the best use of capital. Rather than disagree with some of those correct thoughts, I would just say the beauty of selection is I don't want to own those companies that are just producing a big dividend yield. And you're right, they don't have any better uses of cash.
Right.
And so they send it out and they're not growing. And in fact, they're bleeding in some cases. They may have top line growth that's decelerating. They may be paying out more free cash in dividends than they're even taking in. And those are, in fact, identifying dying companies. The difference with dividend growth of the highest quality with more dry powder to support even future growth is that there's plenty of companies that are growing fantastically well and that also happen to pay a dividend.
Right.
I could get into some of my beautiful conspiracy theories of why, as I've evolved and watched Wall Street, I think some companies really do believe in treating stakeholders better and creating a more consistent stakeholder base.
Sure.
And paying them. And a lot of them are stakeholders themselves, and to be paid along the way, not slowing down growth. So there's companies, and one of my beautiful Mona Lisa charts would be the companies that have growing CapEx and R&D with some of their cash, paying down or eliminating debt altogether, exploding free cash flow, and still the ability to raise dividends. So right off the bat, dividend growth to me is very, very different than dividend companies or high dividend yield. And one of the favorite pages in our playbook, and I think we shared some of this with you, although I can share some graphics afterwards for anybody, that we just showed a very simple traditional dividend, two companies, same industry, high yield that everybody's flocking to if they want income versus a quote unquote low yield of only 2% at the beginning of the period. And at no time during this 10 years did this company ever average anything above a 2% current dividend yield. Some people don't think of as enough to support an income plan. That's a low yield versus the 4 or 5% that some income investors are drawn to. And we showed the simple math, Tim, of the dividend growth, and that's why I call it mailbox money, of looking back and seeing what is my yield now at the end of this period. It was 10 years on my original cost, and it very easily could be 5, 6, 7, 8%.
Or
versus
more.
That 4% that never grew, and in fact may be circling or underlying a dying business.
Right.
So dividend growth is a good clue of what's happening inside of a company, and more importantly, what is happening for an investor, in my opinion.
Yeah, well, and I've touched on this before in some of my own work, that a dividend makes a statement. A dividend says, okay, we've made this money, we've paid the bills, we've paid our salaries, we paid the lights, we paid the tax man, we've paid everybody, we bought back a little bit of stock, and I got money left. Oh, here's an idea. I'll send it to my shareholders. Now, that's a statement that a dividend makes, okay? Especially if the payout ratio is less than 100%. But now growing the dividend says, hey, you know what? We did this again, and I got more money left over. And everybody's paid, and I bought back some stock, and we gave some bonuses to some people, and damn, I've got more money. Well, here, let me send more money to the shareholders. It's making a statement about the health of the business, I think, that is significant. And it's really interesting to me that nobody listens to that statement, because we ran, I'm not the number cruncher that like some of Wes and his Marines and the famous Chinese people in the basement story, if Wes ever told you that one. Did he ever tell you that story? Okay, yeah. We'll tell viewers that here in a minute, but I do like to crunch numbers, and this is like a really important fact that goes into driving stock returns. And it turns out that even in technology, one of the most important determinants of future performance that I could find had nothing to do with stories or AI or internet or R&D. It was dividend growth, and it was like super powerful. So it sounds like you've latched on to that concept and taken it kind of to the next level.
Well, to me, it appeals to both wild ends of the spectrum of an individual investor who may not know anything and be interested at all about what we like to find fascinating. I will simply put that one metric. If you had to pick one, it's been around for 200 plus years, and you can hold in your hand to know it's real. I think we're in a world with all sorts of AI and in the investment world, especially. I don't know what's real sometimes. And there are an explosion of different factors and variables and ways to measure stocks. And I've seen it cripple the most sophisticated investors that are bombarded with all this new data. And you can torture different stats and scoring systems and really whatever you want. But it is the one metric that any investor can hold in their hand to know what's real. But then on the company side, what you're talking about, what I found most fascinating, and you mentioned technology, which is interesting. Most people don't typically think of a technology company when they think of dividends, and they think of these big, fat, juicy moats and these traditional consumer staples and healthcare. And oftentimes, frankly, those crowded moats are awfully expensive.
Yep.
And it's too obvious. And that's the other side of a moat. If it's that clear to see, there's not a lot of upside as an investor versus, and technology is a perfect example. Some of these companies are generating more cash than they know what to do with, even after investing and growing and paying down or off all the debt, buying back their shares. So some of these high growth, darling technology companies that I grew up with in the industry in the late 90s turning into dividend cash cows is fascinating to me, and it's real. And I think it's a wonderful way to allocate capital. And again, it's just a real clue of what's improving inside the business. If you've got that much money and printing cash that fast that you don't have anything else to do with it, there's a lot worse places to start.
Never send me a check. That's right. Yeah, and I love and I have it often, the buyback versus dividend debate. And I'm not anti-stock. In fact, I love stock buybacks. But I'm kind of in not quite as extreme as Warren Buffett, but I'm sort of in that camp. And that if you're buying back stock, it's a great use of shareholder capital at the right price. If I'm buying back stock at 30 times earnings, I'm not creating any value, but you see it every day. However, and everything else can be taken away. Appreciation can be taken away. You buy back stock, the price goes up. Yay, bear market, all gone. Dividend check, it's in my hand. I cash it, goes in my bank account. You can't take that back. And so that's why no matter how inefficient, I'll always believe that it is one of the best uses of shareholder capital. And it may not be as elegant, but it is permanent.
And things and people change. And, so back to that moat analogy, I'd rather find a skinny moat that's actually widening a little bit than a big, fat, giant moat that's clear to see. So companies that start pivoting, and you can start seeing this in the numbers, which is why I'm a slave to the math. It leaves no room for opinions, including my own. Those things start to change. And some of those high growth companies become free cash flow gushers. And Buffett owns one of those. And he might have, like I have, 10, 20, like you said earlier, it could be 25% yield on cost. I mean, Steve Jobs famously said, "I'll never pay a dividend." And now they do. And he's gone to make that happen. Rest in peace. And the next generation of leaders in the company that was generating too much cash than they knew what to do with, they pay a dividend. So I noticed Buffett actually does pretty well collecting that dividend.
Yes, he does.
He owns businesses in the energy field that I actually think is one of the better examples of true change in behavior, where, again, kind of like the high flying growth technology days of some of these energy companies, and people, talk about the environment and limiting capital for some of these energy companies. I'm here in Texas. I can tell you the energy companies can go bankrupt just fine all on their own. You don't have to limit capital. The wildcatting, risk-taking days, they can incinerate capital just fine on their own. But if you really study, and I'm just to I guess a good example of my objectivity. So I didn't own energy companies for 10 years because the math wasn't there. Again, this has no part of my portfolio management has anything to do with what I believe will happen or what I think should happen. A complete profound respect for what is happening. And energy learned a lot of lessons, and they cleaned up their balance sheet, and they eliminated debt. And all of a sudden, free cash flow was exploding because they were more conservatively run and they weren't taking chances. And the dividend became very sacred to some of these companies, and earning trust of stakeholders. And if the market wasn't going to reward these guys with higher share prices for all sorts of political reasons, the stakeholders were absolutely going to be rewarded with the best dividend growth in the most uncrowded, undervalued setup that I've seen in 30 years of my career. And Buffett just happens to own a couple of those too. So he may not be paying or say he believes in a dividend, but he's collecting several. Yeah, and back to your point, I don't think it should be either or, buyback.
I like both.
Be greedy, be selfish, be selective. I call it stakeholder yield. Let's have buyback, dividend, and debt elimination. Let's measure all of them mathematically, what I call stakeholder yield, where it factors in all three of those.
You've been reading my stuff, haven't you, Ryan?
Amen, brother. Hey, we're here for a reason.
We're preaching out of the same book here. I love the energy story because it's, 2015, 2016, you had the drill baby drill and they all went nuts. And an extraordinary amount of them went bankrupt, and they kind of figured out, look, there's a couple of things I can do with my money. I can, really ramp up production. And when I go bankrupt, nobody's going to love me then. They'll hate me when I'm making money, but they won't love me when I need money. But if I just take all this lovely capital and give it back to my shareholders, they'll love me. The regulators, the government, the activists, never going to love me no matter what I do. But the shareholders will. And you're right. They learned and they pivoted. And we see it in a lot of industries when they figure out that the best thing they can do is reward their stakeholders.
And it's another good lesson. It's easy for me to say this because I don't let politics touch any portfolio. And again, math makes that real clear. But anybody who does dig in their heels on any side of any debate, energy is an also powerful example of, when we wrote, and we share a lot of our playbook, we like to communicate because it sharpens our sword and pencil. And we collected a lot of wise people. I'm talking to one of them right now as a result of that flywheel. But my only prediction, I didn't let it touch the portfolio, was this was a couple of years ago when I saw what was happening inside these energy companies that had gotten so efficient while nobody was looking. And, their break even down to $40 a barrel for oil or $2 for natural gas. They had this excess cash. And despite what folks believe, they're not all evil, greedy capitalists who they themselves have kids and grandkids. And my only prediction was for the environmentalists out here that haven't turned us off yet. It is who better to know how to solve some of our worst dirty problems than the guys with the blueprints in the first place. So my only prediction was watch some of the biggest upside surprises for the climate come from some of the energy companies that have great solutions that are entirely incented, and capitalism does a great job of this. And the best example of all that is just unquestionable is the switch from coal to natural gas in this country has done more for the climate than any initiative ever. And we should lean into that technology and lead the rest of the world, because we can talk all we want about one little plastic solution or protest in this country. But if they're switching from wood to coal in a country with 1 billion people, the world is going to be a heck of a lot better off with our technology and our cheap natural gas, which has been the best dividend for the climate imaginable.
Yep. Again, we're drawing out of the same playbook. Which part of Texas are you in, by the way?
I'm in Houston.
Okay, my wife's a San Antonio girl.
I've got a lot of family there too. It is hot right now.
Well, look, I'm in South Florida, so we can match hot stories. It's the Gulf of Mexico, a couple miles from the house here. We love to go to the beach. The water's 92 degrees. It's like getting into a spa. It's crazy. But all right, now look, I don't need you to give away the secret sauce or anything, but let's go as far into the math as you're willing to go of how we set these, how do we find these companies?
I have no secrets. And even some of my favorites that are hiding in plain sight. The beauty, as you know, with investors and behavior, you could give away secrets and nobody's going to take them. The consistency and the repeatable process really is the holy grail. I mean, any one of these on its own is worth nothing. The repeatable system disciplines, both buy and sell disciplines, are what I'm unafraid of sharing any and all of, because that consistency is really the hard part. So we have a very, very simple quantifiable process where we're looking at operating business advantages by themselves without attaching any other metric yet, and not dividends yet, not value, nothing. Operating business advantage, and we're talking about heat and power here in a second. And I have a big giant bill on my table just off the side of the screen right now for an HVAC replacement. There are some operating businesses where you don't get to ask as the consumer, how much do I want to pay for this, or how long do I want to wait? I actually, my only question was, do you want me to mail this to you, or do you want to come by and pick it up today? Because I want to get this in your hands as fast as I possibly can.
Before it goes up.
And some of those businesses have been around 50, 100 plus years. But measuring mathematically those operating businesses and simple measure, like people would be, and I'll use one example. So operating revenue versus simple top line sales or revenue growth. Most traditional metrics, and a lot of people can do a lot of this stuff on their own online screens for free, better than I could at that biggest brokerage firm in the world 27 years ago. But we just want to go a little bit deeper and a little second order thinking. So rather than just looking at sales, which can come from any sort of non-repeatable event, the operating business, and obviously the cash flow, the margins. We're going to want to look at whatever's left over. We look at the quality of the dividend next, which we've talked about a little bit. Again, easy to reach payout ratio, which we talked about. That's one simple measure. We talked about debt and stakeholder yield and all those other ways to measure the quality of the dividend. I like to go a little deeper, and we actually measure the cash payout ratio as opposed to earnings. That can be a little more manipulated. So free cash flow payout.
Oh, I like that. I really like that. Yes.
Yeah, and very repeatable and consistent, or we're not interested.
Okay.
So those two starting gates, the operating business advantage, where it is, the quality of the dividend and its direction and growth, and then where we really roll up our sleeves, Tim, and where I found the biggest advantage or special sauce, if it is one, although again, it's just math, is rather than just look at those growth rates, for example, and the moats that we talked about, what is the direction of each? So there can be wildly successful, high profit margin businesses that are leaking. Every moat can spring a leak, and they can be decelerating. A big, giant profit margin that's stuck or even slightly declining is a lot less interesting to me than a relatively small profit margin where the numbers suggest they found something that's more uncrowded because is it expanding? And it may be expanding rapidly. And you can also see this in the dividend itself. So there's a lot of dividend funds and dividend growth solutions, but the acceleration of our dividend is double or triple our peers. And so that's where I want all of our work to be. The evidence should be in our stakeholders' hands. So it's really the advantage, and the growth is wonderful, but we're measuring the direction of those advantages, which also serves
you want to see that up and to the right,
which serves to eliminate most traditional dividend companies that may be wildly popular and well known, but they are bleeding. And that's why you don't see a lot of the big, giant, expensive consumer names in our portfolio. And when there's thousands of companies to choose from, and we're not going to own any more than 50, you can be awfully, awfully picky. And then the fourth step of the repeatable process, and we haven't looked at this yet, which I find as an advantage also, rather than have a value metric that it's got to go through these filters, instead of each one of these steps are independent of another. So once we've got these candidates, I always call this a stock tournament, and we hold them every Saturday. I'm a basketball junkie, so I literally have these brackets. And because I think this is a lot of fun too. Dirty little secret, fun is an underrated part of a business plan.
Sure.
But when the stock tickers are not moving and the market's closed and my phone's not ringing, we literally hold these tournaments where this fourth play-in round is price, it's valuation. And as long as we're going to be picky and believe in active management, and this is where I really think active management has its advantage, why not wait for high quality candidates in what we just talked about? And we have several dozen ways to measure each of those first three. I just hit on a couple, and then wait to underpay for them. So if we have, and I have 5 kids, so I rip out all the efficient market theories in their textbooks. I rip out all those chapters in their economic textbooks, and my simple evidence would be, if the markets are so efficient, then these superior growing companies that are higher quality should be more expensive. And yet I own, and the back of our card would show pretty clearly, we have higher growth and we have below average valuation for the same exact roster. So if you build that roster carefully, I believe you can have both. And then roster construction is a big deal to me, rather than be tipping to one side of the boat like a lot of dividend fund managers do, no differently than a lot of high growth managers do, and they take too much concentrated risk. We'll be in all sectors at all times. So that balance and that discipline, and then a sell discipline under each one of them, that not only keeps me out of a lot of trouble risk-wise, but it allows me to be exposed to some surprising growth opportunities where a lot of dividend hunting investors would not think to look.
It also allows you, by breaking out by sectors, to treat the valuation differently. Because
Amen.
if you just picked a random valuation variable and applied it to the market, said, okay, here's the 50 cheapest that also meet my other criteria, you've kind of made a mistake, because financials use one metric, energy uses another, and tech may well use a whole nother. So correct me if I'm wrong, but I think it gives you an opportunity to break out the metrics that work on a particular part of the market.
I think that's a wonderful point you make for all of your loyal listeners. And because I choose then to each one of the sectors is its separate bracket. So they're competing against each other as opposed to competing against a cheap utility stock.
Right.
That is a great point. And the dynamic nature of that. And I just believe competition not only is best to sharpen the swords of businesses that stand the test of time, but I think your roster of stocks should feel the same pressure. I want my 51st guy in the minor leagues wanting to desperately get in the last spot on the bench.
Right.
So the reason I hold these every week, not for high turnover, and we may go weeks and months without any changes, but when the inputs change, since math and price changes, so should the outputs, as opposed to being dug in on, I did all this research, as too many fundamental investors, all of our behavior biases would be, if I've done 3 years of research for this particular company, I'm a little reluctant to let it go. And if it goes down, I'm real interested in doubling down and averaging down. I think all of those open the barn doors for absolute destruction. So we'd never add one penny to a losing position and let any sort of overweight be organically outperformance only. Yeah. It should be the only way anybody listening to this, in my opinion, should have an overweight position, as opposed to a table pounding, I'm going to add more.
I love it. Right, exactly.
And that's a big key.
Okay.
And all that takes is humility. And that's the exact opposite of investment knowledge and conviction, by the way, which I think is the secret holy grail to this whole game.
Okay. And now let's touch on turnover just a little bit. How do you track your turnover ratio at all? Do you know how much it is? I suspect even with weekly examination, I suspect it's not that high.
It's not. And now that it's a publicly traded ETF, I mean, all that data will be available in alpha crunches and all of it disclosed. And, I have no preset. I'm not surprised if there's nothing that changes, and I won't be reluctant if we have to make 3 changes out of a roster of 50. And if recently we had a sell stop kick in and one of them wasn't ready to go on the bench, we'll drop to 49 companies. Okay. I don't believe in any preset formula other than after 50, in my personal mathematical opinion, over a lot of years of studying this, whatever your magic number is, the benefit of diversification does start to meaningfully erode.
Yeah. Graham put it at 30, but there were a lot less stocks in the marketplace back in Ben's day.
I think both work. I think that's right. Directionally, that's right. But a lot of people listening to this to 300 or 3,000. And so 30 or 50, I wouldn't argue with either. I agree.
Okay, now I'm chewing a huge hole in your Friday, but so far you haven't stopped me. So
this is fun. Keep going. However long you want. You got me.
In your literature and here today, you've alluded to sell discipline. And in my mind, this is what most people get wrong. And even me, it's one that I will freely admit I screw up more than anything else. When do you sell?
Okay. And I'm a big believer on this. I wrote a post when I was inside the belly of beast, when compliance would no longer allow this. And the title of it, we've written to our stakeholders every year since then. It was, how do you know when to sell? And that's one part of our process that hadn't changed in 27 years. And I will submit, no matter what my answer is, if anybody comes up with their own answer to that and simply sticks with it, in my humble opinion, you will have an above average chance of outperforming every investor, including professional investors that you know. So whatever the number is, if it is an absolute number that once I put a position on, 20%, 15%, 50, whatever the number is, that suits you and your style, if you stick to it, I believe you've just given yourself a tremendous gift of peace of mind. And mathematically, you're going to do fine, because you will stumble into 500% winners So as long as you limit your losses to any degree, I think you're way ahead of the game. As you might guess, I nerd out a lot more beyond that. So I have an absolute sell discipline for every single position, but I also have a relative sell discipline, speaking of competition, so that a company may have done nothing wrong, but if it gets beat out,
by another
that's
company.
another sell discipline. I also have an absolute strength in the market, buying and selling pressure, where no matter how right I might be, the math might be, there are going to be absolute technical levers where I shoot first, ask questions later. In any one of those fundamental, technical, absolute price, whatever a sell discipline might be, give yourself the grace and permission to just adopt one of them, and know that I don't know a single professional investor personally that sticks with any sell discipline. So you've given yourself a gift. And by the way, it works in life too. I mean, like anything, like my friend used to joke, and I took this and I adopted it. It's like, instead of buying a new pair of jeans, stop eating. I pushed back the dessert. I took his. It works with all sorts of things. And the real aha moment for me was, it's not limiting like most go-go investors that somehow think that's going to maybe cost them the big winner, and it's somehow limiting. And that's why they don't stick with it, because they'll make an exception. Mm-hmm. And this one's too good. I'm going to drop it a little. What it in fact is liberating.
Yes. I'm going to touch it. You've introduced one of my all-time favorite stories, and I've told this often, and I'm going to tell it again. And I'm only going to use one guy, but I could pull a dozen professional traders out of the pocket on this one. And you just said that most investors, you can give them the secret sauce and they'll go broke. They still can't do it. Now, Paul Tudor Jones is probably the best trader, or one of the best traders of all time. Paul is a legend. He's a remarkable human being on top of everything else. Amen. And he learned at his own. When I lived up in Maryland, he learned the lesson of tangling with the EPA. But other than that, he's a brilliant guy. And Paul has known for picking market bottoms over time. And he's made some dramatic calls in a wide range of markets, including the crash of '87 and one of the giant recoveries. And so they asked him once, said, Paul, you make these giant market predictions. How are you right so often? And Tudor Jones said, well, it's funny. Paul Tudor Jones picks the market bottom. That's a great story, isn't it? He says, it's not a great story? Paul Tudor Jones picks the market bottom on his 17th attempt, right? And on the first 16, he takes small losses. Because if you're always taking a series of small losses, you're never out of the game. And that way you're in position for that 500% gain that you alluded to. And the sad part about that story, Ryan, is that I could sit you down, not you, because you've got the discipline, but I could sit the average investor who wants to be a trader down next to Paul in Paul's trading room and say, you just mimic his signals all day and you're going to make a fortune. That individual investor is going to fail. I'm going to tell you why. Because when Paul takes a 2-tick loss, the individual is going to look at that screen and say, I'm going to hold on a few minutes because it'll come back. And that's the lack of a sell discipline. But having that sell discipline is a much bigger key to investment success than people realize.
Well, the best of the best, and you picked one of the exceptions who stood the test of time and done exceptionally well for a lot of good reasons. But the best of the best professional money managers, almost every single one of them eventually get carried out on their shield for the same exact reason, conviction and leverage. And so the same exact piece from almost 30 years ago that I would share with anybody listening to this today, that anybody can apply on their own. It was really, really simple. And I shared with you my numbers of limiting to 1 or 2%, whatever the number is, a small percentage of capital in any one idea. Right. And it's over a portfolio, it's a fraction of a fraction. But whatever the number is, if you limit your exposure to a small percent of your nest egg, no matter what that nest egg is. Yeah. Too many people think I'll get disciplined later when it's bigger. Start early and it will be big. And 2, you never add 1 red cent to a losing position. Mm-hmm. And 3, you have some price of which you've already decided before you buy it when you're out. if you simply did those three things, no matter how good or bad you were, you would never let one bad idea ever open the barn door to destruction for a portfolio nest egg. And if you stay in the game by limiting that and avoiding that, you are going to give yourself incredible opportunity to wildly outperform all of the indexes and professionals that everybody's intimidated you to think can't be done. It can be done, and discipline's the answer.
I absolutely, yeah, I 100% agree. Sell discipline, and I'm an old guy. That took me longer than anything else to learn. There's got to be a point, and we use quite often in some positions, we use a fundamental sell. It's like, okay, I don't really know what the price did, but the return on equity slipped, or the debt went up instead of down. And that's just, the flag goes up, I'm gone. It's bye-bye, we're out. We can't be here anymore because it's going to get worse. And the one thing that I've learned in the stock market is if you're relying on a trend to reverse, a negative trend, it's never going to. It's just going to keep getting worse and worse and worse and worse until you sell. Then I promise you it will start to get better the next day.
And what I meant about liberating the math, the upside of this is it unleashes that dry powder to be seeded in other opportunities. So, right. And if you view any small loss instead of an agonizing defeat, but rather a tuition payment that you are going to collect on, I think you've just reframed the question. So anyways, it was something I was thankful to learn early on. And it's really clear to see the common similar problems for any business or investor that goes under. If businessman too, or woman, like same thing applies. Like at some level, a stop loss, I can't keep adding to that business line if it doesn't, and it works beautifully. Maya Angelou said it best. It works with relationships. Somebody disappoints you for the third or fourth time. Where's the stop? Like Maya Angelou said, when people show you who they are, believe them. Same thing with companies. It works beautifully. That one quote has saved me more money than any other.
Yes, absolutely. All right, look, I have chewed a hole in your Friday afternoon. I can't take too much more, but I do have to deal with some of the important questions of the day because now you're in Texas, I'm in Florida. This is the first college football weekend of the year. So this is big. Who's your team?
Well, it's going to be put to the test early here because the unthinkable has happened in my household. I went to the University of Texas.
This is why I told this story.
Oh, okay. I didn't know. Okay. I didn't know if anybody knew this.
You remember, you told me early on.
I'm still having a hard time saying this out loud. But I've grown to fall in love with the town. So at some point, maybe I'll like the school. So me and my younger son will be going to visit my college freshman in Tuscaloosa in a couple of weeks for the Alabama-Texas game. And my only question to him is, which shirt are you wearing? So I have a freshman at Alabama. I have a senior at LSU somehow. And neither one of them were interested in Texas. So SEC Saturday, a weekend down here in the South, anywhere in any of those schools is a experience that I highly encourage anybody listening to this to try at least once.
At least, or in Texas, even more so than Florida, although Florida has the disease. But if you ever saw the show Friday Night Lights, you get into a small town in Texas on a Friday night, forget it. You're not going to the local, right? You're not going anywhere because everybody's at the football game.
And now some of those football stadiums are bigger than most of the colleges in the rest of the country. These high schools in Texas.
Absolutely. Well, let's see now. None of your three are opening this weekend, are they? Texas, Alabama, or LSU?
That is correct. But Friday Night Lights, Texas high school football starts in a couple hours after we get off the phone here.
Well, see, high school football started here last night. There's a high school just down the road from us, so we can always hear the band and the yelling and the screaming, which when we're out walking the dogs at night, which is kind of cool.
Yeah.
Of course. Now, tomorrow, I've got Navy Notre Dame.
Oh.
Having grown up in Annapolis, I did not go to the academy. Trust me, I never had the discipline to have gone to a service academy, but big Navy football fan because I grew up with it.
That's going to be great. A night game in Ireland, right?
In Ireland, yes. Now, the real dilemma comes in because I'm also an Irish Catholic kid that grew up in the 60s and 70s. So, Notre Dame was a big deal. So you got Notre Dame, Navy, two of the teams that I root for. So I'll just sit here and be conflicted and eat popcorn and hopefully enjoy a really good football game. But Ryan, you have been so ridiculously generous with your time, your ideas, your philosophy. I want to thank you for that. The ticker symbol on the ETF again, guys, is MBOX. I'm not traditionally really a huge, more of an individual security than an ETF guy, but I think this particular ETF is one of a standout list of about a half a dozen that I can look at and say, this probably has a place and a big place in your retirement plan, particularly if you're, at that 40-year-old age where yield on cost 20 years from now could make a huge difference in your life. Closing thoughts.
Well, this was a treat for me. Thanks for having me. We have a lot in common. You'll know where my attention is. I'm not the football game. It's where the majority of my own personal money is, which is a great filter, not even having nothing to do with me. The best track record, Morningstar has been pretty clear about this. Find some managers with skin in the game. This has all of my attention, and it's a delight to share the playbook. And I feel like we're just getting started. So thank you. And I love listening to your show. So it was an honor to be on.
Well, thank you. That's very nice of you to say. I
think it's uncommonly good, and I listen to a lot. It's a gift to the folks that listen to you, and I can see why they do.
Well, I guess, there's a few out there. I've got a couple relatives left that still listen. I mean, I don't know, but thank you. Those are very kind words, and I do appreciate it. All right, let's make it a point to talk again real soon, on or off the air. I've enjoyed every minute of this. And again, thank you for the hat. You don't know how often, by the way, I get yelled at by my wife because you see, I'm getting a little thinner up here, and I forget that. And that sun down here, it's not a joke. So having a sunburned head, you learn lessons, unless you're me, and then you have to have your wife yell at you. But now I've got a new, very cool hat with a mailbox on it, so I'm excited.
She's got one less thing to yell at you about. You are welcome.
One less is it's a dent in a very large number. But thanks a lot. I really appreciate your time today, and thank you again.
Absolutely. Thank you.